Welcome to Liquidity Provider, the show where we break down real strategies for earning yield in DeFi. I'm Alain, joined by Sarah. Let's get into today's topic.
So, picture this. You wake up, you grab your coffee, and you pull out your phone to check your crypto portfolio.
Like a morning ritual at this point.
Right, exactly.
Right.
So you open the app, you stare at the screen, and you just let out this long, frustrated sigh. Because the charts are just grinding sideways.
Oh, yeah.
They are stuck in this totally directionless, endlessly boring loop. You've been waiting for a massive breakout, or honestly, even a dramatic dip just to feel something.
Just some kind of action.
Yeah. But that breakout never comes. Day after day, it's just a flat, uninspiring line. Sound familiar?
Painfully familiar for most people.
It's a scenario that really tests the patience of even the most seasoned market participants out there.
It is arguably the most frustrating environment for anyone who looks at markets with a traditional directional mindset. I mean, you're sitting there, your capital is totally tied up, and seemingly nothing of consequence is happening.
It's just dead money.
Exactly. The boredom is palpable. But in the financial world, boredom is very often where the smartest, quietest money is being made. When the flashy headlines stop, the structural advantages of certain market mechanics really start to shine.
And that is the perfect setup for what we're exploring today. We've got a fantastic piece of source material in front of us.
Really great read.
It is. It's an insightful breakdown by Elaine Maker. And the title just perfectly captures the sentiment. It's called "The Market Everyone Hates is the Market LPs Love."
And when we say LPs, we're talking about liquidity providers.
Right, liquidity providers. So the mission for this deep dive is to completely flip the script on market boredom.
Love it.
We're going to show you exactly how these sideways, do-nothing markets that are driving you crazy are actually absolute gold mines if you understand how to position yourself. Okay, let's unpack this.
It really requires a fundamental shift in how you view market activity, though. We are so conditioned to believe that profit only comes from predicting direction.
Like buy low, sell high.
Exactly. We think we have to guess the future. Is the asset going up or is it going down? But Elaine Maker's piece points out a structural reality of decentralized finance.
Which is what, exactly?
You don't always need to predict the destination. Sometimes you just need to own the road.
Ooh, I like that. Own the road. Let's look at the current state of Bitcoin to really ground this in reality, because the source lays out the numbers perfectly. Right now, Bitcoin is trading around $69,000.
Right.
But let's look back at the immediate history. A week ago, it was at $67,100. A month ago, $70,400.
So it's just oscillating.
It is. It's stuck in this roughly 5% range. It's not decisively breaking up to new all-time highs.
And it's not collapsing down into a bear market either.
No, it's just chopping sideways. For a day trader, that is a total nightmare.
And that brings us to what Elaine Maker calls the LP paradox. It's a really fascinating concept. If you think about the broader ecosystem, different market conditions reward different participants.
Sure.
When there's a massive bull run, the directional traders win. They buy low, sell high, ride the momentum. When the market crashes, the short sellers win. They borrow the asset, sell it, buy it back cheaper.
But what happens when the market just chops sideways for weeks or even months?
That is the LP paradox. When the market does nothing, the liquidity providers win.
Let's get into the mechanics of why that actually happens. You listening likely already know the basic concept of a liquidity pool, right? You're depositing a pair of assets so others can trade against them.
Right, the traditional automated market maker model.
Yeah. But Elaine Maker's thesis relies heavily on the modern iteration of this, which is concentrated liquidity.
This is key.
Instead of spreading your capital across an infinite price curve from 0 to infinity, you are picking a very specific price boundary. Let's say you decide to only provide liquidity between $67,000 and $70,000 for Bitcoin.
What's fascinating here is that by concentrating your capital in that specific band, you are maximizing your fee generation for the current market reality.
Because your money is only working right where the action is.
Exactly. Yeah. As an LP in this scenario, you are entirely agnostic to the ultimate long-term outcome of the asset. You really don't care if Bitcoin is eventually going to $100,000.
So we're down to $40,000 next year.
Nope. Your only concern is that right now, people keep trading within the walls you've built. As long as the price stays inside your defined range, every little wiggle, every fake out, every minor dip in recovery.
All just a fee-generating event for you?
Yes.
But, I mean, there has to be a catch. We both know there's no free lunch in crypto.
Definitely not.
If I set up this concentrated range, How does the market punish me? Let's say I set my boundaries between 67 and 70,000.
Okay.
And tomorrow, a massive piece of institutional adoption news breaks, and Bitcoin just shoots up 30% in 2 days.
Oh, wow.
Yeah, it blows right past my $70,000 ceiling. Intuitively, I'd think, great, my Bitcoin is way more valuable now. But I know that's not how an automated market maker works. What is actually happening to my position in that nightmare scenario?
That is the exact nightmare scenario for an LP, yes. And it brings us to the concept of impermanent loss at its absolute worst.
Walk us through it.
When you provide liquidity for a pair, say Bitcoin and USDC, the automated market maker, the AMM, is mathematically designed to keep the dollar value of both sides of your pool balanced within your specific range.
Okay, balance.
So as the price of Bitcoin surges toward your $70,000 upper boundary, the AMM is systematically selling off your Bitcoin to buyers and taking in their USDC.
So it's essentially taking profits too early on the way up.
It is continuously scaling out of the appreciating asset. By the time the price completely breaches your $70,000 ceiling, you have 0 Bitcoin left in that position.
0. Wow.
You are holding 100% USDC. You captured a few transaction fees on the way up, sure, but you're now sitting fully in the stablecoin. You're completely sidelined while Bitcoin continues its massive 30% run up to $80,000 or $90,000.
You completely missed the structural gain because you traded your upside potential for a handful of transaction fees.
Exactly. That is why LPs dread parabolic bull runs.
Or sudden catastrophic crashes, I imagine. Because the exact reverse happens on the way down, right? The AMM uses all your stable coins to buy the crashing asset all the way to the bottom of your range.
Leaving you holding bags of a depreciating asset.
It really is a double-edged sword.
It is. If the price escapes your net too quickly in either direction, you suffer. But if we contrast that with the dream scenario, you start to see why the current boring market is so incredibly lucrative.
Right. Elaine Maker describes the ideal scenario as a market bouncing continuously between 2 price levels.
The ping
ping-pong
pong
market.
stock market, yes.
Price goes up a little bit, traders buy, hoping for that long-awaited breakout. The breakout fails, the price comes down a little bit, traders panic and get stopped out. Up and down, round and round.
If we connect this to the bigger picture, it synthesizes perfectly why professional market makers absolutely love this specific environment. They are looking for 2 specific conditions: high trading volume combined with low directional risk. When a market is ranging, the turnover is constant. People are opening and closing positions relentlessly.
Because they're trying to scalp small profits, or they just keep getting chopped up by the fake-outs.
Right. The math works beautifully for the LP because that high turnover generates massive fee volume, while the low overall directional movement keeps your risk of impermanent loss practically at 0.
You are just continuously harvesting the friction of the market's indecision.
Harvesting the friction, I like that.
So the theory makes a lot of sense, but the source material really drives this home with some staggering real-time numbers.
The numbers are wild.
They really are. Elaine Maker pulled data from Degate, which, if you aren't familiar, is a prominent decentralized exchange, specifically looking at their turbo range pools.
These are pools that allow users to concentrate liquidity very tightly.
Right. So he looked at the current 7-day annual percentage yields, or APYs. The numbers for some of these pools are just wild. Circle is sitting at a 174% APY.
Right.
MicroStrategy, MSTR, is at 152%.
Those numbers are eye-catching, for sure, but we need to provide some critical context here so we don't misrepresent the risk profile. Numbers like 174% do not exist in a vacuum.
Right, they're not guaranteed forever.
Exactly. Those specific pools for Circle and MicroStrategy represent highly volatile equities, or what we might call hype plays in the current cycle.
Because everyone is trading them right now.
Yes. Their incredible yields are being driven by intense earnings volatility and a very heavy flow of news. Directional traders are aggressively speculating on those specific names.
Which creates massive volume.
Massive volume, which translates to high fees for LPs, but it also carries a much higher risk of the price suddenly gapping out of your range.
Okay, but here's where it gets really interesting, though. Because you might look at MicroStrategy and say, well, of course that's generating fees. It's incredibly volatile right now. But look at the base assets.
Yeah, let's look at the base asset.
Elaine Maker points out that Bitcoin is generating a 64.3% APY. Gold, specifically the tokenized version, PAXG, is sitting at 46.5%. And even if we look at traditional equities that have been tokenized, NVIDIA is at 28.4%, and the S&P 500 is at 20.8%.
That is the crucial takeaway from Maker's analysis. Bitcoin and gold are not currently hype plays. They are the foundational base assets of their respective economies.
So we have to ask the why behind those specific numbers.
Right. Why are the most boring, most established assets paying out over 60% or 40% annualized?
Crazy.
It's because this massive yield is coming from sustained trading volume within a choppy, highly uncertain macro environment.
It's the literal range-bound market paying out in real time. It's almost hard to wrap your head around when you're used to just buying and holding. I mean, you are making a 64% APY on Bitcoin precisely because Bitcoin is doing absolutely nothing.
It perfectly illustrates the thesis. The market that directional traders hate, because they can't catch a trend, is the market that is quietly paying out massive dividends to the people providing the infrastructure for all that fruitless trading.
The uncertainty itself becomes the yield.
Exactly.
Speaking of uncertainty, the source shifts focus over to the Ethereum situation, which paints a slightly different but equally compelling picture.
Yeah, ETH has been a completely different beast lately.
While Bitcoin has been doing this relatively tight, predictable grind sideways, ETH has been much messier. Elaine Maker points out that last month, Ethereum dropped all the way down to $1,800.
Which was a brutal drop.
Yeah, and then it recovered and pushed above $2,000.
Mm.
And right now, it is sitting in this 10% band of just genuine, pure uncertainty.
It is a perfect example of heavily contested price territory. A 10% band.
That's a wrap on today's episode. Thanks for listening to Liquidity Provider. If you want to put these strategies to work, check out D-Gate Turbo Range. Link is in the description. New episode every week. Hit subscribe, and we'll see you next time.